President Kenyatta has declined to approve the finance bill and has instead asked MPs to scrap commercial lendings rate caps that critics say have led to a credit squeeze. Should MPs now agree with him and remove the cap, borrowers will be left at the mercy of banks on the one hand, or on the other hand, while on the other, the banks will have the freedom to price their loans depending on their risks assessment. Kenyatta is in agreement, I should say, with the Treasury at the Central Bank of Kenya that the interest rate cap is hurting the economy. The argument is that the cap has cut private sector loan growth because banks have avoided lending to customers deemed as risky, including small and medium-sized businesses, as well as individuals who borrow for consumption. It remains to be seen how lawmakers will react to President's recommendations to repeal the cap, given that MPs have twice rejected attempts by the Treasury to push for a repeal of the law that ushered in the caps. Mr. Kenyatta will seek to use his numerical strength in Parliament to marshal the numbers needed to override MPs and to repeal the law. On the other hand, MPs will require two-thirds majority, or 233 lawmakers, to overturn the President's memorandum on the amendments. So which way to go as far as these loans are concerned? And we want to just delve deeper into the discussion with our panelists this morning to tell us more of what they think so far as this interest cap is concerned. They're saying it is hurting the economy. Is that so? Looking at the Business Daily, it seems the banks also recovered from the interest cap blowbacks. And this is what now they're posting. Bank shares gain 38 billion shillings in a day on rate cap push. I think because of the news that the MPs will actually repeal this cap. I'm joined this morning by Patrick Obath, who is the Vice President of KEPSA Foundation, also a managing partner at Adam Smith International. Also, we have Stanley Manduku, who is an advocate of the High Court, an expert also on oil and gas. We are joined as well by Dr. Gituru Wanaina, who is a lecturer at the University of Nairobi School of Business and also the chair of the Kenya School of Government. Also, we're joined by the chairman of Kenya Association of Manufacturers. This is Sanchan Gudka. Good morning, gentlemen.
Morning.
Morning. Right. So let's just begin with you, Patrick. Looking at this Business Daily as well, and the story that is ongoing as far as expensive loans is concerned and repealing the cap. What is your assessment? Bank shares, they are gaining 38 billion shillings in a day on rate cap push.
I think this is typically what happens in a stock market. I mean, when people see whatever they pretend are potentially good things,
optimism rises.
Optimism rises, and then the prices go up. The reality will kick in soon, and eventually it'll come down to reality from that point of view. But I think this is basically a reaction to the fact that the whole issue of rate cap has been boiling in this country for some time. And the impact of putting it in has been seen in terms of the impact on the economy. Money has not been available for borrowing because every bank has been lending to the government because there's no risk, literally, in terms of default, and the returns are not unreasonable. So, and any business that is worth their money, any sort of management, will put the investment where they get the best returns to the shareholder. And that is really what has been happening. But now what has flipped is the fact that there is now an opportunity for making money in a different way. Because I think lending to the government at that rate was great, but the opportunity of actually playing within the community in Kenya was actually quite diminished because there's not enough money in the economy. So with this happening, it means that obviously some of the money will now move into some different instruments where banks will then be able to set set the rate based on the risk that money is going to be exposed to. And that is a key thing. I mean, a lot of organizations, irrespective of whether they're banks and so forth, you tend to invest based on your risk appetite. And then if the risk is good and the people are willing to pay a little bit more, you put your money there. And it's on that basis, on the way banks and generally financial institutions operate, that the removal of the rate cap has created, I think, this excitement about the fact that now there'll be a lot more play in the market and therefore a little bit more money to be made. But again, the reality is that are people going to be able to take on that money at that kind of level? That's the first thing. The second thing is that if you look at this, one of the hidden things in here is that the MPs do not want an increase in the rates for the people who had borrowed money at the previous rate. So there's going to be a large chunk of people who are going to be locked in at that cap. And the banks are not going to be able to sort of extract that money and begin to have a floating interest rate like they've had in the past. So whilst it may sound as though there is going to be all of a sudden a big increase in borrowing, it will not happen the way I think some of the speculation that is happening on bank shares is going. But certainly I think the excitement is there that now there's a free market, money can be played around as was happening before, and therefore there's an opportunity for making money. That's what this headline says to me.
All right, but we see also, I think we got an assurance from the banks that yes, if you took your current loan with the current interest rate, that will not be affected. So that is an assurance from the banks as well for them that are having bugbears and fears. You can tell us more on that as well. You as a chair of a Standard Chartered Bank.
I think these are I'll have to sort of call
yourself.
myself on that. But I think generally the banking industry has been negotiating this as an industry.
Okay.
Right, and the industry has, I think, part of the play they've had is that yes, we'll not change that thing, but we will now open up other opportunities, and that I think was basically part of the negotiating skill. Sort of position that were taken between the banking industry and the Treasury.
All right, so we've seen this failing twice in Parliament, and right now analysts are saying it is likely to pass because of numerical strength for the president, and of course also the spirit of handshake. So each maybe a side will try and marshal their troops as well. Is there a likelihood of this being repealed, Stanley Manduku?
Okay, first of all, I want to slightly disagree with my brother and colleague,
yes,
Mr. Obath. Now, I think there are a number of things I want to say about all this. There's a presumption that by opening up the caps, that a lot of money will be lent to the SMEs, and it will be available for lending because the risk profile will be evaluated and it will be priced accordingly. But when you look at it strictly, with the backdrop whereby the government borrowing ceiling has been lifted, there's every possibility that a lot of banks will find it attractive to still continue lending the government. Now, in view of the fact that the ceiling has been raised from the 6 trillion to 9 trillion. And this is because, obviously, of what we've been hearing and what we know. The cost of running the government is a bit high compared with the very many other challenges. Now, the second issue, this is a position I'd held earlier on, I think, in this particular show. What determines interest rate that is payable in a particular lending is the loan agreement. It is contractual. And you realize that the loan agreement, the way ordinarily they are crafted, they do not have a fixed interest rate. They are crafted in such a way that that interest rate is variable depending on the economic dictates of the day.
Yes.
Now, in a situation whereby what was limiting the increase of that interest was a piece of legislation,
yes,
and these legislations have been amended to remove the ceiling or the cap, then obviously it will be legal, it will be contractual, and it will be open for the banks to raise that particular interest, and it will be within their powers to do so. And I think that's why my very good friend is not very committal on the fact that the banks will really not raise the interest. And then other issues that we'll want to talk about is that the fact that the access to credit is not so much about the interest rates, but it's about the requirements that enable somebody to access that particular credit.
Yes.
That is why you find that there's still a very big, huge of the Kenyan populace that is being served by Shylocks. There's another very huge populace that is being served by digital lenders, actually, whose interest rates are 40, almost 50%. And yet they still have business. That's why they keep on coming up every other day. And then the whole issue about credit and all that obviously depends on a matured economy. And I don't think that we have reached that level whereby the free market can really dictate. Now, as to whether there's a possibility of the repeal of that particular section, is not something that you can say at the moment, but it actually depends on how things move. Yeah, I wouldn't mind tomorrow if maybe another member of parliament decides to bring a private member's bill to introduce another capping, as it was done with this capping that has just been done away with. So that one really, it really depends on how the situation unfolds.
All right. Yeah. Dr. Gichuru Onaina, good morning.
Morning. And welcome back.
Thank you.
I think we have had a whole scenario of bringing the capping, and I think it's important to step back and find exactly what did we learn from that. But I'm really not so much, and I believe strongly, unless I can't say landed friend, but the Wakili here, I believe in free market. I think it's important to let the demand and the supply play out in the markets. And what I see perhaps we need to work on is the margin than anything else. What do I mean? If you borrow, and you borrow at maybe 20%, and if I invest, the return I get, we should work on that margin. Like today, that margin is so huge, so that he can come for a loan, I give him a 22%. When he invests, I give him 3%. And probably I'll be all the way going to the bank. And I think that somehow, I think the central bank, in my view, should come in and almost give the parameters of that margin. Because if you look to most economies which are thriving, and I'm really not talking about developed economies like Ghana, which is perhaps performing very well, they have really worked on that margin. And the whole thing comes from the business. If I borrow at 22%, and you go to the industry in terms of what is the return in that, maybe I'm running a hotel. What's the return in that industry? And you compare with how much I'm borrowing that amount. Then you have to bring some sanity in terms of if I invest, how much do I get? And if you can work on the margin, you go to somewhere like UK, I think it's almost like a 0.25%. So, and those economies, that's what they work on. So that's something perhaps we can look at it, letting it, and I think this has been a very fight that we let the interest free, not capping, but let's work on the margins and anything else. I'm sorry, there are some banks there, and about this in the chair of Standard Bank, which they're on one pillar only. They're on one engine, borrowing and lending. The other pillars they can come up with for this growth. For example, they can go in a very clear pillar of investment advice to the private sector. If the private sector, and I probably mentioned this down the road, want to support government in terms of development investment, is it possible to influence that is the investor, and there are special rates we can provide in terms of borrowing?
Okay, let's also hear from Sir Chan on this, because do you think this particular repeal is premature? We had accountants also coming to the fore and saying, and they met the finance committee, they were saying, why can't we get an extension of 2 years, or for actually 2 years, so that we can realize the benefit of this, interest caps? So do you think from your own assessment the repeal is premature? We should have waited a little bit longer to see the trickle-down effect?
No, I am with Professor on this as a disciple of free market economics.
Yes.
And we need to get back to risk-based lending to ensure that there is lending being unlocked to especially the SMEs which have been locked out of this segment. But in general, what we have in the economy currently is we have very little economic or fiscal firepower left for a stimulus. Will the repeal of the interest rate cap bring in a stimulus into the economy? I think there is a general environment of what we call extreme risk aversion at the moment, where businesses are, business community is scared to invest, the consumer is scared to consume,
yes,
and lenders are scared of lending both to business and to consumers because they don't know whether they'll get their money back. So essentially we've got a vicious, what we call cycle at the moment. There are two things. I also agree with Patrick that keeping the old or keeping existing arrangements in place. So if I have a loan for 5 years and keeping that interest rate in place for existing loans is probably a good compromise to get this over the line. However, any new lending will be at risk-based rates. However, if I was a private member and I wanted to introduce a bill, I would introduce the usury bill, which actually states, because at one time, before the interest rate cap, the delta, as Professor says, between lending and borrowing was nearly 20% with some banks, and that is simply not sustainable in this economy, and that's why the sledgehammer of the interest rate cap came in. So we need to get back to what we call introduce the usury bill into this, which basically caps the delta between borrowing and lending. I also, the overnight lending splurge we've seen, which is unregulated. You have, by taking into account the administration costs as well as the overnight interest rates, you're coming to an APR close not to 40 to 50% a year, it's nearly 400 to 500% a year. People don't realize this. So, but in desperation, they're reaching out for what we call overnight loans, and this sector is completely unregulated. And the central bank needs to step in and bring in control on the mobile-based lending, as well as on the overnight lending rates, because this is causing a huge dampener on consumption in the economy.
But I think one of the other things, just jumping into this discussion about looking at the difference between the lending and the borrowing. Some of the key things that are driving the margin need is the cost of securitization. When you talk about, for example, getting a title deed secured, the process you have to go through and the risk that there is in the lands office and so forth and so on, because that is one of the most popular items that are used for securing loans, especially at the lower level of the economy, right? That is fraught with risks, and you've seen the way people have got title deeds and then, yeah? So the cost of actually making sure that that title deed is real is extremely high. That's the first thing that happens in that space.
It's a nightmare.
Yeah, that's a nightmare.
It's a nightmare.
And who absorbs that cost? That cost is passed directly onto the consumer.
Correct.
So when you talk about the risk, the sort of the margin need, we need to sort of unpack why is it that that difference is so big, right? And if you begin to answer each of the questions that are actually creating that margin need, you will find that you begin to shrink the margin need, and therefore the difference between the borrowing and the lending will actually become a lot more realistic compared to other economies, right? The issue of digitization of the lands office, that has been on the cards for, I don't know, 10, 15 years.
Yes.
And it keeps going backwards and forwards and backwards and forwards. That needs to be tackled. Those are some of the little things that if they're put into place properly, then the cost of lending will begin to come down, and we get to a more real play in that area. I think the other realization, the other thing that is happening.
There's something you say there, and I think we should not miss it. It's not the big things, it's the small things.
The small things, yeah.
Like that issue of the land. I've been going through one, it's a nightmare.
Right.
Getting a title, even between government agencies, it's taken like 3 months. Government themselves, government to government.
So we don't really trust the sanctity of
It's
our
not a
title
big
deeds,
thing.
Exactly.
as it is right now.
Yeah.
And if you bring in, Dr. Bitange Ndemo talks about blockchain as an opportunity.
Yes.
If you begin to bring in things like technology to basically guard that space, then even the fact that if you move your loan from one bank to another, it can be done at the press of a button. But at the moment, if you want to move your loan and sort of consolidate your loans into one bank, what happens is you go through the same process of ensuring the security is the same, just moving from one bank to another. So even between banks, moving a security is a huge cost.
Right. So,
from that point of view.
So there are many facets and consecutive factors that are actually rising to, or maybe contributing.
There's also a third facet, which is our esteemed lawyers having a lock on the legal fees they charge for essentially copying, pasting a lot of documents. But really, I think the Competition Authority also needs to look at the lawyers' fees and the way they've created scale fees and so on, because that stifles competition and moving debentures.
But the beauty
I think I need to step in and say one thing. When you're looking at the cost of lending, there are three main things. The first thing is that we have got all these other facility fees and charges. They are charged separately. We also have the cost of securitization, especially in land. We are talking about the legal fees and charges, and we're also talking about the stamp duties. And then we have the interest. So I think it is good to contextualize the debate within what are we talking about. Ordinarily, when it comes to issue of securitization, the legal fee, the client or the borrower is told to meet them separately. It is not factored into the interest. What we are talking about here is the lifting of the interest cap, that aspect only, in respect to the revenues that are accruing to the amount of money that has been borrowed. I think if we look at it, if we can be able to dissect that particular aspect and we look at it that way, then we can be able to have a more reasoned discussion. What we are saying is that we have all those challenges, especially in respect to securitization and all that. And what is supposed to be done, like now as advocates, we are actually required to take out indemnity so that in the event that there are errors, then the professional indemnity will come and cover. And then also government should be more responsible in the event that it issues titles which at the end of the day are declared to be invalid. That should not be the basis upon which an interest rate should go up. And then thirdly, not all loans are secured by interest. There are those loans that are unsecured. There are those loans that are secured by other securities like logbooks and all that, and debentures, really. So you realize when you look at the cost of securitization when it comes to that, you realize that it cannot be a justification as to why interest rates should go up.
But I think, just coming back, you're absolutely right. If you look at people who have been in a bank for some time and they've been performing well as customers, you are able to negotiate a better interest rate because they know your performance, you've got a track record, and so forth. So what needs to happen again is now, in terms of in the bigger picture, we need to now create instruments that allows for use of big data. We are going into a data protection bill, which basically says lock. And the minute you do that, the use of big data then, in terms of trying to create a risk profile, then is beginning to be locked up. But if you're able to use that kind of data of your performance, how you've been performing in all the different financial areas you're in, it will make the cost of credit much lower. You go to the United States, I do not need to go into any brick and mortar to get a loan. I can basically use my app, apply for a loan, and the minute I do that, artificial intelligence steps in on the other side. And I don't see it, but they have a huge bank of data that has been built up over years. Right from the time you're born, literally, they're beginning to profile you as an individual across very many agencies. And at that point in time, your credit risk profile is known as an individual. Absolutely. Not based on land or whatever it is, but based on the way you handle money. And therefore, when you are loaned money, it is based on your own performance. So nobody's to blame apart from yourself. So you don't talk about the bank, you don't talk about anybody, it is you and your own performance.
Credit score.
And ideally, we need to go very quickly to a situation whereby we open up how do you pay your electricity bills, how do you pay your water bills, how do you pay your sort of insurance. All these elements come into a central database that can then be used for artificial intelligence. If we do that, you will rapidly find that the cost of credit and the access to credit is much easier. Now, when you look at developments now digitally, some of the online lending platforms, are basically doing exactly that in an area where they have very little data. So that is why you find that their rates are extremely high. So they're opening up, because they're not regulated, they're opening up an opportunity for borrowing, but they're charging you because of that lack of data to ensure that you're a good borrower. So I think we need to open up this discussion in a different way. Our traditional instruments we have now are extremely inefficient in terms of creating a borrowing environment that will actually answer to the consumer's need.
There is a deliberate attempt not to try and also digitize all these items so that people also can actually benefit, you know, from the dead hand of bureaucracy out of it, especially from, you know, even the lawyer side. Because you can see, especially now with the e-government, which has been taking it to, or has been very slow on the uptake, there is also that beauty that we don't have to go through the lawyers. We can actually do all the registration through online, and you know, we can file up you know, our documents and submit them to the necessary agencies as well without going through the lawyers. But there has been a deliberate attempt, especially even from the Lands Ministry, not to digitize you know, the documents or the entire process, so that people can actually be getting from the system as it is.
I think really the problem is not the lawyers. The problem is the banking system that is not responsive. Why am I saying things? First of all, when you're even talking about the free market economy and all this, it presupposes a situation whereby the two sides have equal bargaining power. But those of you, anybody who has already borrowed from a loan from a bank, you go there and then you are told this is the interest rate. They sit down, they do their calculations, they say the cost of credit, blah, 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 it has gone up. They send you a notice, they tell you that the interest rate now has moved from 15% to 16%. You really have got no choice about it. So what Mr. Obath is saying here, it is the best, or it is the way to go, whereby we can be able to have a situation where the borrower and the lender can be able to sit down and actually have a discussion about all this. Because initially when you're borrowing, they'll come, they'll entice you, they'll send you very salespeople who will do a very good job when it comes to negotiating and all that. Fine, but the moment you've already signed on the dotted line, then basically you seize control. They will always raise the interest the way they want to. The advantage we had is that they could only raise to a certain limit, but now that limit has been removed. Then my guess, the guess on what will happen, I think your guess will be as good as mine.
But I think the point you are making here is, how do you entice investors to go and borrow? I think that's the point you're making. And we're trying to blame all this. I don't think it's a lawyer or whatever. It's a whole system of people there. And I think Obath is right on. By the way, we have what we call Credit Rating Bureau. CRB. And they have data about 18 million Kenyans. I think it's the will to embrace data and use it.
Yes.
It's there. And there's a gentleman learning it in Upper Hill. A lot of information. But he unwilling too. And probably, my colleague, with all due respect, at times I look at the whole system of the judiciary, they're some years behind. The issue of a judgment is where you can leverage it today. There's technology to leverage on that. And I can get the cases within a very short time. The case is determined. And those are the small things. You go to a case, it takes ages to be determined. A business person, my colleague is not going for that forever. You go to the RAD office. All these charges which come in, I think that's what you're talking about. If you made it easier for me to go to bank and borrow, I would borrow. But now it's a nightmare. And that's the point Obath is making. You should have that information. And you say, why is risk vis-a-vis you are carrying? So maybe if you're less risk than me, I don't even have to call you. I'll just have advance you their own. And I extend my argument, perhaps even to the business community. If he's running a apparel and textile company, I probably even call him, come over. Your risk is good, and I get this loan, move on.
All right. I think just going back on this Credit Reference Bureau, part of our mental thinking is that the Credit Reference Bureau is a bad thing.
Okay, exactly.
That is the way we think as Kenyans, that the CRB is a bad thing. You don't want your name to be there. Yet, I mean, personally, and I'll talk on a personal basis, I look at my Credit Reference Bureau score every 3 months, just to make sure it's on the green side.
How many
and
Kenyans
if I see it going towards the orange, I go back and find out what is it that is happening on the other side,
yes,
so that I can keep it green, right? Because I know there are so many things that depend on that score. Right now, if I'm going to join a board, they look at that thing, right? As a board member, do you have a proper fiduciary record? And that is what they look at. So I fight to make that record green, and then I actually am quite proud to use it. But most Kenyans think that if I go to the Credit Reference Bureau, you know, this is an area I don't want to go to because it is red all the time. Yeah, so I think a lot of work needs to be done in terms of just educating us and making it possible that people voluntarily put their data in so they have green records.
And I think maybe also we can come. Let's hear from Sachin first of all, before I also ask the next question on the Credit Reference Bureau.
I think just to come into why is the debt ceiling, the lifting of the debt ceiling, is going to continue to crowd out private sector through government borrowing from banks. And I think that's the real elephant in the room that needs to be answered, because our debt levels, I mean, we're seeing that here, debt driving Kenya to the tipping point, is we are in a distressed situation. And I feel that we need to calibrate our income with our expenditure and cut our expenditure accordingly, because otherwise we're going to continue to see what we call the crowding out of the private sector from the borrowing space.
Correct.
Even if we go back to risk-based lending, and the desired fiscal stimulus that is required to kickstart this economy is going to be a real issue again. Yeah.
Right.